Cracking the Cash Flow Code. And my guest today is David Blauzvern. I hope I got his name right, from CSG Partners. They're an investment bank that specializes in employee stock ownership plans, otherwise known as ESOPs. It's something I love to talk about, and it's something that really gets down with the people listening to this podcast, but it is an extra strategy you need to learn about. So let's bring David on and start the conversation. Hey, David, how are you today?
Doing well. Thank you for having me, Josh.
My pleasure. So did I massacre your name, or did I get it almost right?
You got it right. You're part of the 10% that gets it right on the first try. So good job.
Cool. So let's start off really, really basic. What is an ESOP?
An ESOP, short for Employee Stock Ownership Plan, is a vehicle for owners of privately held businesses to sell their equity to an ESOP trust who ultimately ends up benefiting the employees of the company. It's a way for an owner to take some liquidity off the table or all of their liquidity off the table. You don't have to just structure an ESOP sale as a 100% sale of your equity. Many of our clients, in fact, the majority of the deals we're doing lately are minority sales. You just want to take some chips off the table. So you can sell your equity to an ESOP trust, and then the idea is that it's a retirement plan. The stock that is held within this trust ends up getting allocated to all of your employees over an extended period of time. And it unlocks a lot of neat items, not only from the owner's perspective, but for the company as well. If you think about a company's cash flow for a privately held business, what usually you're probably set up as an LLC or an S corp, and you have pass-through income flowing to you, and that's how you're paying your taxes. From an owner's standpoint, when you sell your equity to an ESOP, you have the ability to defer and ultimately eliminate your capital gains tax that is due on that sale if you elect what's called 1042 of the tax code. For any listeners that are active in the real estate world, it's very similar to a 1031, but 1042 was created specifically for ESOP transactions. And then from the company's standpoint, companies have the ability to become 100% tax free at the corporate level. So it unlocks a lot of a tax efficiency, it unlocks liquidity for an owner, and it creates the opportunity to get equity in the hands of all of your employees that have been working for you for years, and also layer in some additional incentives for your management team.
So, David, the economic benefits of an ESOP are what generally gets a business owner's attention. But there's the non-economic side, the corporate governance side, and the way you run your company really needs to be completely different than when you're not sharing any information, because now you have to share information. And you really should be having an ESOP committee within your company that helps make decisions about how the company is run. And what I have found in my experience is that people who do ESOPs just for the economic value, those ESOPs tend to not last for a long time. But the people who do ESOPs for the economic value and the culture value of having an ESOP, those are the ones that tend to last for years and years and years. So can you talk about the culture side a little bit?
Thank you for bringing that up, and I agree completely. When folks initially come to us that are really focused on the culture and the company that they've built, because many times for a privately held business, this company is your baby, and you don't want to just sell to a third party. Now, one misconception from the get-go is that if you sell to an ESOP or if you sell to a third party, whether it's a private equity buyer or a strategic buyer, there's going to be changes in the day-to-day operations of your business. Now, when you sell to an ESOP, one, an ESOP can pay exactly what a financial buyer can pay. So if you're looking to maybe sell to a private equity firm, an ESOP can pay the same amount of money. It can't pay what a strategic buyer can pay. And when you think about the operations and the day-to-day activities that may be going on in your company, If you sell to a third party, there may likely be changes in management. You may have a third party who's telling you how to run your business, who to hire and fire, and there may be changes that you're not used to. Now, when you sell to an ESOP, whether you do a minority sale or a majority sale, there's no change in the day-to-day operations of your business. Whether you're stepping down as the owner, you'll still be on the board of the company, or maybe you have a management team that's taking over for you. I- An ESOP trustee is not coming in to tell you how to run your business. They will be a part of um, the yearly operations, but they really have a fiduciary obligation to make sure that you're not doing anything that would not favor the participating employees. So you still run your business, you still make those key decisions, and nobody's really over your shoulder telling you what to do. And that's a significant benefit from day one.
So, David, this is something that just occurred to me. It didn't just occur to me. I've known about this for a while. Is that as an ESOP trustee, you are required by law to be a fiduciary, which means that you, under most circumstances, need to consider all offers that come in to buy the company. And if a big offer comes in, you're required to take it. Now, what I'm seeing, King Arthur Flour is a really good example of doing this, is they converted to a benefit corporation and they became B Lab certified, which allows them to say, wait a minute, private equity companies, we are not just for sale based on the numbers. There are other things that we need to consider along. So it seems to me that becoming a benefit corporation helps with keeping the ESOP where it wants to be, but it also helps you keep within running a corporation with the culture of an ESOP. And do you see that much with the people you're working with?
I'm not too familiar. We've come across B corporations. I'm not too familiar with how layering that in plays into what you're talking about. What I can say is that just because you have an ESOP in place does not mean that at any point in the future you can't sell your business to a third party. Now, let's say you sell your business to an ESOP and maybe you sold to the ESOP for a 7 times multiple of adjusted EBITDA. And let's say you have a third party come along years down the line and they offer you 3 times, right? If you, for some reason, were trying to take that offer as the owner of that company or the person running the board or folks running the board, that's when the trustee would raise their hand and say, well, I think that's significantly below fair market value, right? Now, if you have an offer come in at, um, let's say, 12 times, significantly above the current valuation, there's two things that I want to point out. Privately held businesses have people calling upon them to sell their business, sometimes on a daily basis. Just because somebody calls you and gives you an offer for your business does not mean you're obligated to take it. You need to be out to market with a purpose to sell the business. If you go down the line of getting an LOI and you're clearly intent on seeking out uh, that transaction, that's a different story, right? The trustee, I think, would say you have a 12 times offer, significantly above fair market value. It's a great deal not only for the employees, but for the management team and for the owners as well. So just because somebody comes along and gives you an offer, if you're not out to market seeking that, you don't have to take that offer.
But what if you get that 12 times offer and you haven't put something into your corporation as a poison pill to keep from accepting that offer because your intention is to stay it as an ESOP for as long as you possibly can?
What you mentioned may very well be this poison pill type setup. I am not familiar with that item, but what I can say is that if unless you are out to market seeking third party offers just because somebody calls upon you, you, you know, it's almost like some a sales call coming into your cell phone. You don't have to engage in that conversation. So unless
Right.
you're out to market, you keep your ESOP as is, you keep the culture as is, and you don't have to worry about it.
So for those listening, this is a really good example of some of the complications that happen with an ESOP is there's really no hardcore rules about what you need to do when a suitor come calling. Now, I know I talked to the ex-president of King Arthur extensively for their reason for becoming a B Corp. And that was the reason. They were getting offers they did not want to accept. And the trustee kept saying, well, you got to really consider these things. So their reason for becoming a benefit corporation was to really put the trustee back on their heels and say, okay, the economics are good, but the other stuff is not good for what makes our company unique and special. And becoming a benefit corporation allowed them to consider more about what the fiduciary responsibility of the owners of the company are, i.e., the trustee in this case, about what the company would do and what it wouldn't do when suitors came calling. And that's something that, if you happen to have a very attractive company like King Arthur Flour is, it's one of our big employers in southern Vermont, and you really want to stay as an ESOP, which is what the employees want to do, the extra money is not the only determining factor for them now because they're a benefit corporation. They've gone through the certification, and the trustee does not have to consider private equity offers, which would likely ruin the culture of the company, at least in their opinion. So that's something that uh, is it's relatively new actually because B Labs has only been around for not for a zillion years, and it's something that you see ESOPs and B Corps talking about who have that particular problem. So let's pivot for a second. We're a smaller company. We're not really worried about a corporate raider coming in or a private equity company saying, well, you got to talk to us. We're really at the level where we have, 50, 75 employees, small manufacturing company, good sized construction company, not especially easily done on a third party sale, especially for construction companies. And you decide to form an ESOP. So the cost for this is not insignificant. So, David, can we talk a little bit about what it costs to put the ESOP together in the correct way? Now, there's a lot of promoters out there saying you can do an ESOP for $35,000, $50,000. And can you talk about why that might not be the best option for you?
Well, I think it all comes down to two things: process and your objectives. So when you're setting up an ESOP transaction, there's no one way to do it. Okay, there may be folks that are very interested in 100% S Corp ESOPs, but sometimes step one is always understanding the objectives of an owner or owners of a company. Because unlike a third party sale, where the guardrails may be put in place and there's very little area to pull a certain lever to maybe get something else that you were seeking in a transaction, an ESOP transaction is you determining your destiny. You can create an ESOP 100 different ways. You can do a minority sale, you can do a majority sale. It can be for succession planning, it can be for a management buyout. There are many things to take into consideration. So step one is, what are your objectives? And based on those objectives, how can we tailor an ESOP to best match your what you're seeking to be your exit or partial exit and liquidity event, so that you can establish an ESOP, create a platform that allows for employees to significantly benefit at no cost to them. Again, assuming your company continues to grow and operate the way it has been, because an ESOP is a free benefit to all employees. It's not like a 401k plan where you have to say, I want to give 5% of my W-2 comp to this. Instead, it's a free benefit, zero impact on their compensation. So we need to come up with the objectives that align well, um, or the ESOP structure that aligns well with their objectives. And in order to do so, we view a transaction in two phases. So for phase one, it's usually about $10,000. And with that, we will tell you, based on your objectives, how would we recommend structuring an ESOP transaction, how much capital we can raise for that transaction, and what your after-tax cash flows look like, not only from the owner's perspective, but for the company, the employees, and the key management team as well. Now, after that phase one, when you move into a phase two of the transaction, which is when we get the green light to move forward, it's typical to any M&A transaction. I'd say on the low end, it's usually about $250,000 to get a really good ESOP in place. Um, Most parties are success driven. I'd say anywhere from 85 to 90% of our fees are not paid until an ESOP is closed and the financing is in the pockets of the owners. Now, process is key. ESOPs are overseen, it's an ERISA benefit plan. It's overseen not only from the company standpoint by the IRS, but the DOL as well. And you want to make sure that when you're establishing an ESOP, you are dotting your I's and crossing your T's. There are folks that say and do set up ESOPs for $35,000, but I wouldn't recommend that. You want to have the right process, the right parties involved. You want to have an independent trustee representing the employees. Sometimes you may hear that you can self-trustee an ESOP. You can. I wouldn't recommend it. I think that process is key. You want to have an ESOP selection committee to interview and ultimately select a trustee for the company. And there's many things to think about as you're setting up that ESOP.
So it's not a simple thing. It's actually a very, very complicated transaction. And unless you, I mean, for a smaller ESOP, again, unless you're also willing or interested in the part of the ESOP where I want to run my company as an ESOP, which means I want to include people in decision making. We want to run with open book management, which means that we share our numbers with our employees, not necessarily salaries, but everything else we're going to share. And these are things that make ESOPs work well because now you've got employee engagement, not only from the retirement plan side, but also from I get to have a say in how the company is run. And
Well,
that's important.
I want to point out one thing. So process is absolutely key, but it's not, of course, we're focusing on the complexities of the transaction. And this is why you want to make sure you're working with advisors, accountants, and counsel that fully understands what an ESOP is. And from the owner's perspective, hopefully we make that as simple and seamless as possible. Um, but when you think about the performance of the company, you don't have to share all of your numbers on an annual basis with the employees. The employees are going to receive, just like they do with their 401k plan, you're going to have a third party administrator for an ESOP. And what that third party administrator will provide to your employees on an annual basis is how many shares have I received from the ESOP and what is the value of those shares. You don't have to start opening your books and showing every employee everything that's going on in the business. We certainly have clients who do, right? It's nice to show the top line of your business and encourage employees to keep ticking that number up and performing better versus last year. But it's not a requirement. So I just want to draw that line there and let you know that.
Yeah, I can just tell you from my experience that whether you're an ESOP or not, if you run your company with open book, you're going to get better performance than the people who don't. I did it myself with my food service company for 20 years. Everybody I know who has done it has seen that same effect. And I won't get into a long conversation about this because it's a whole session by itself. And I'm trying to get a friend of mine, Ted Castle, to come on board, who is the open book management guru I know in Vermont, anyhow. David, let's we only have a little bit of time left, but there's a really powerful thing about S Corporation ESOPs, which very few people I see talk about. And that is, it is an unbelievable business structure to buy other businesses. Can you talk about that for a minute? Because, boy, if you want to grow your business and you're willing to look at alternative ways of creating value for yourself and your employees, a fully owned SESOP is like a magic bullet. So, can you talk about that a bit for a few minutes?
Absolutely. 100% S Corp ESOPs are the state of nirvana in the ESOP world. Okay, it's when the company's corporate cash flow essentially becomes 100% tax-free at the federal level and most state levels. Now, I say most because, for example, if you're in California, you can't escape the 1.5% franchise tax. But generally speaking, your corporate income becomes 100% tax free. And if you're at the point where you've already delevered the initial ESOP transaction, you're generating all of this cash flow that's building up on your company's books year after year. And you can use your pre-tax dollars to start thinking about, well, maybe there are other companies that I want to acquire in my space or expand into a different space that aligns well with my business. And it gives you that opportunity to do so, right? In the status quo, you earn a dollar, you pay anywhere from 40 to 50 cents on that dollar to Uncle Sam. Now you make a dollar, you have a dollar that you can put on your balance sheet and think about whether it's for my own company's general working capital purposes, or do I want to start thinking about making acquisitions in my space? It gives you that opportunity to do so.
So I used to write a blog for the New York Times, and one of the blog posts I did was on a very large ESOP transaction that happened where an wholly owned ESOP bought a very large electric distributor in Salt Lake City. And they did it for two reasons. One is because it was all pre-tax dollars, they could pay more than the other suitors. And two, because the seller was really concerned about how their employees were going to be treated, they were given 100% investing in the ESOP as part of the transaction. So it gave the buyer in this particular case what I would call an unfair advantage over the other two suitors, which were public companies and had to buy with after tax dollars. And it was a cash deal on top of it. It wasn't a stock swap. So there you go. And it's just, to me, if you want to grow your business and you're really in a position where you can build a business that goes from 75 employees to 400 or 500 employees, and you have the ability and the ambition to do so, being an S corporation ESOP might be the best way to go about that. Does that make sense,
Absolutely.
David?
And I'll say if you visit our site, csgpartners.com, we have a resource section on the top right. An ESOP can provide different benefits depending on what industry you're in. Manufacturing has different benefits than, for example, if you're in GovCon. Construction companies are a perfect fit for ESOP transactions because of the family and the legacy concerns and the culture that you've generally built up in that business. Consumer goods businesses. Definitely visit our site. And I hope that you find that information to be fruitful for what you're hoping to learn about.
So speaking of that, David, unfortunately, we're out of time. So tell us a little bit about your company and where can we find you?
Again, csgpartners.com. We are headquartered out of New York City. I'm out of Boston. We have folks sprinkled throughout the United States, and you can do an ESOP transaction as long as you are a U.S. operated company. We do deals every year from Hawaii to New York. Any questions? Education is 60-70% of what we do. It's a niche product, and we're happy to speak with you and learn about what you're going through and to see if an ESOP may be a good fit.
Cool. And I highly recommend you folks take a look at this. Go visit the site, learn a little bit about ESOPs. It's something that you want to talk about as you're thinking about an exit strategy for your business. You may not do it. Most people say no at the end of the day, but it's still something that really will make you a better seller because now you'll see what you have to do to make it work for an ESOP. And that will make you a better seller, which gives you a more sale ready company, which means buyers will become more interested in you just because of the work you've done. Hey, this is Josh Patrick, and I got a couple of things for you to do too. I've asked you to do this like a zillion times, which is please go to wherever you're listening to this podcast and give us an honest rating and review. I hope it's 5 stars, but sometimes people say, it wasn't so great, and then I'll cry a little bit, but I'll get over it. And the second thing is we have a program called the Financial Freedom Accelerator. And what happens is, I was just doing some research. There's 8.7 million businesses with employees in this country, and less than 0.3% have over 100 employees. So that means most of you are probably not going to be getting to financial freedom with your business alone. So you need to know what's next. And that's what the Financial Freedom Accelerator is all about. I invite you to learn a little bit more about it and have a conversation, see if it's right for you. The way to find more information is you go to www.sustainablebusiness.co/freedom. That's www josh.sustainablebusiness.co/freedom. If you find what you see there interesting, click on the Talk to Josh button and we'll spend 20 minutes where we'll help you figure out whether your company is sale ready and how you go about doing that. So this is Josh Patrick. We're with David Blauzvern from CSG Partners. You're at Cracking the Cash Flow Code. Thanks a lot for stopping by. I hope to see you back here really soon.